Markets around the world have just experienced the worst day since March, but what does history tell us about the turning points for markets moving forward? Hello ladies and gentlemen, and welcome back to The Daily Show. We discuss stocks, commodities and cryptos together. The S&P 500 made fresh lows, but will it find a recovery right around this level? Also, semiconductors, the strongest market sector, continues to look weak. The biggest stock in the world has just made a new low. And of course, high yield junk bonds. What are the markets telling us about the risks moving forward? That and more coming up today. Well, welcome back everyone to The Daily Show, where we talk about markets around the world. We're of course discussing the macro, lead indicators and the hottest charts. Thanks for bearing with us over the last couple of days. Of course, we've had our Vegas conference, which was an incredible success. I loved meeting so many of you out there in the community, and I look forward to, of course, coming back in the future. Hopefully, we can get even more members of the community sharing their ideas. Let's begin over here, though, when it comes back to everything to do with markets, and it was red. AAPL, Amazon, Google, all selling, and it's really been in line with what we've discussed over the last couple of weeks. A sell-off into the back of September is not always necessarily the worst thing for the rest of the year. In fact, it could be seen as an incredible opportunity. Fear and Greed Index, we shared this over on our Twitter X account, links in the description down below. Fear is now reaching a 28 reading. Now this is obviously a low reading, and we've seen over here over a year ago we were in extreme fear 17. So we're starting to get down into those lines of maybe beginning to become a little bit oversold. But it's not time yet to celebrate any type of recovery, and the reason why is something like our bullish percent index, again shared over on our Twitter X account. You can see here that we're seeing some red signs, and we had a fair idea that we saw what we call a dead cat bounce or a false rally just a few weeks ago using this indicator. What we're looking for now is some form of capitulation. That's usually a really large sell-off day, pushing this kind of market down further and then giving us some nice, big, strong, bullish candles. We haven't seen it yet, but we will update you on the channel, so make sure to subscribe, hit the alerts and follow along. Let's get into some data. Let's get into some stat history. We knew that this week was going to be bad. In fact, it's usually traditionally in these situations down. It was down 17 times, only up 7 times over this historical average, and it's really basically in line with everything we're expecting. 3% plus in terms of sell-off. It can get a lot worse. Obviously, we've seen sometimes 8% as much sell-off during this period of time. But once we see that, what happens next? Well, when we get a sell-off such as we have had in September and August, then we do tend to lead into pretty strong October, November, December runs. In fact, in the last similar kind of situations, over the October to December run, if you took all the stat across the board, we're actually still sitting at 100% bullish positivity. Now, data stats are just that. They're data, they're interesting, they help us, but of course, October could turn, and that's going to be really important. Here's another one in terms of using just slightly different data here. When the S&P 500 performance went down in both 1% or more for both August and September, we usually have stats that state that basically markets should recover through October, and then Q4 actually ends at 92.3% positivity. So that's a pretty good stat. Basically, it's showing you that if we're going to see a recovery, we don't necessarily get it until maybe the middle of October, but then we then tend to lead into stronger November and Decembers. And there'll be more information coming out about that as we make some more videos over the next couple of days to show you how strong some of those data stats really are. What about S&P 500 ratios? Are things getting cheap yet? Well, the forward PE ratios are not quite there yet. We're sitting at about 18 times, which is definitely an improvement on where we have been. And we're looking towards forward PE ratios realistically going back down to ideally around 16.5 to 17. Now, why is this so important? Well, it's the average over time. But you can also see here, because high yields, that is yields in general, are breaking to new highs, this is an inverted real rate, that we do expect that markets are kind of repricing themselves to this higher interest rate environment. This new fear of the unknown is really pushing these markets down. Interestingly, if we hit some of the levels for S&P 500 moving forward, we should be getting into around that 16.5 structure in terms of forward PE. So really the opportunity could be just around the corner for markets should we continue to sell. Now for buyers, can we rejoice yet? Well, one good sign, fairly large transaction coming in, no late prints yet, but we will update you if we see any of these. Basically, somebody did buy the dip at the close of today's market. We don't know whether they're going to get any rip yet, but someone did buy the dip, and that brings into question this market structure here and whether the market can get past those points. In fact, the Russell 2000 could be one of the better charts to be watching right now, and we'll bring it up later on today's video. A lot of other people are saying, why is gold not doing well? A lot of that has to do with yields. We did say that when we see the 2-year and the long date yields going up, that's a bit of a problem for gold. And we hit some targets recently, but still a lot of transactions going through. In fact, the largest transaction of the last 2 years going through iShares Gold Trust in the last 24 hours. I doubt it's a sell, but the problem is, remember, they don't buy with stop losses taken into mind. So I think that's kind of important to note here when we're looking at these things. Let's take a look at some options activity now before we get into the charts. Anything unusual? Well, there were a few largest trades. The S&P 500 is continuing to get higher than 90-day average volumes at 1.18. And we can see here some other interesting ones. We saw a lot of activity in Amazon. That's now being taken over almost by put volume, but still a lot of people buying the dip. 545,000 calls to 428,000 puts. So really, even though the market's falling off quite substantially, we're still getting a pretty close put to call ratio. And usually in the past, we have been seeing puts being much higher. So 53% puts, 47% calls, 36 million volume versus a standard, kind of 40 mil volume. So again, the options market, pretty active, but still a lot of buy the dip type of scenarios coming through. Let's move over now to rotation and what we've been seeing there. In the rotation world, it has been mostly defensive. Things like healthcare have held up very well. XLV, staples have been in there as well. Utilities really disappointing the last couple of days. We talked about that getting strong. Utilities need to find pretty much a buyer straight away in the next session. They're still at a good level. I don't think they've made a new low just yet, but utilities is certainly one to watch for us. And semiconductors, of course, 3.65%. So they've kind of stopped the bleeding as much as they have been. We saw Nvidia find a little bit of a bounce and so on and so forth. In terms of what we had for the session itself, it was defensives across the board, still showing more selling could come, though utilities down here at 2.99%. Still very, very bad sell there for them. And as I said, it sold off way more than you'd think in the last session. Let's now take a look at what's doing the damage. And this has changed a little bit. This was taken from just a few days ago, but it's to really illustrate what the problem is right now. Of course, we've got, shutdowns looming, everything else you can think of. Negativity is everywhere and everything to do with the world. But really, you need to be looking at these high yields as well. So we need to be looking at the future of Fed funds rates. Higher for longer is the story, and you can see here based on this blue line how every single time anything's going on with the Fed recently, and we do have a Fed kind of speech coming out this week, although it shouldn't really be moving markets too much, what we're seeing is basically the market pricing less and less and less rate cuts for higher for longer, but also just basically no rate cuts for even longer periods of time as well. So if that continues, expect the market to not like it, and we need to be watching yields very closely, and we'll discuss that in just a moment. But first up, let's have a look here at the percentage of stocks above the 200-day average. Now, this is back to where we were in March. So again, bulls are going to be looking at this and saying, well, we're a little bit oversold, aren't we? We're getting back down to those March levels. Surely it's time to buy. This is showing you that it's getting a little bit better. Of course, it has fallen before all the way down to 20s. 20s is usually a pretty good area. That's a super area to buy, so keep that in mind for this market. But look at this one here. This is the percentage stocks above the 50-day moving average. That's back down to the March lows. We're not quite at those 10 kind of points here, which happened in September of last year. So something to watch. Looking at the structure, we're looking at turns coming through on these points. Percentage of stocks are below the 20 or above the 20-day moving average. You can see here only 17%, again getting closer to those March sell-off lows. So markets are certainly selling fairly aggressively here, and it's something that we do want to be paying attention to. The VIX finally starts to come up. Now, people have been looking at this VIX and saying the VIX is broken, it doesn't do anything, there's no fear anymore. Well, we're back to 18.93. Historically, if you've been looking at VIXs and you're thinking, okay, where does the market end up finishing a sell? You're usually looking at a plus 25 reading first. That's to bring fear back on board. So imagine if we got a combo like plus 25 fear, we're seeing those percentage of stocks above 200 hitting into those lower kind of 20s. That would be amazing. And then, of course, we get things like really the PE ratios and stuff improving. That'd be a really great combo to say, well, maybe it's worth buying the dip. But in this case, fear plus 25 would be what we'd like, VIX going up. And volatility of the volatility, the VVIX is also at 103 now. So certainly one to be watching. We can load up our skew index as well, which we've been following for a while. That's kind of floating in the middle, so I wouldn't say it's giving us too much extra information there, but certainly something that we should be paying attention to. And do remember, continue to watch yields. In particular, you want to have your US 2-year, US 10-year, which you can see is in the fear and the unknown. And if you go to like a US 20Y or 30Y, what you'll notice is that these ones are really copying the brunt of new highs as well. So we can see we're totally in a different environment than we were. Day change has really been breaking out for quite a while now. And really since the back of September, this is what happens. You get the fear of the unknown, you get market sell-offs. Watch yields. The markets really care about this at the stage. High yield junk bonds, this is another one that we've often considered. We're back down to our lows. So that really means that if we continue to break through, like let's say we see another day of sell-off in high yield junk bonds, it's telling us that the markets should be moving even further to the downside. And that's pushing in that 4150, 4200 narrative that we've talked about many, many times on this channel. Could that be the actual real low of these markets? It'd be a pretty fantastic kind of turnaround in terms of, right on those levels that you'd be expecting. Home builders, another one we're watching, new low forming on this. And the good thing about all these new lows is what they're doing is they're starting to build some structure. So you can see here we've got that 77.12 read now. I think we'll have a fair idea when the market's possibly going to turn, because if this was the low, let's say markets hold this little area of demand on the S&P 500 and we see rallies coming through, especially on home builders, that's usually a good sign that the buy the dip is back in and we're starting to see a bit of a rip or a squeeze. So home builders, one to watch. Treasuries, I'm going to give you guys a clap here. Absolutely smashed it. So many people out there were not predicting that this could happen. And while we don't really like to predict, we were certainly incredibly cautious on the market, finding any buyers realistically around that 92.80. So I think I've got a lot of messages from everybody. A lot of you guys were very cautious here. Now you're getting excited. I totally see why. We're back down to the 88s. This is actually hitting into a box that we've talked about now for a year. We've talked a long time about this level. So very exciting for treasury buyers because it's right in the zone that you would expect. Why is this so good? Because if you go back through history, this is 2010, 2011, and we'll do some specials on 2011 again and how treasuries act, because we've got some similarities again coming into this market. For now though, we haven't seen a buy, we haven't seen any bounces or anything going on. So certainly one to be watching. US dollar, very difficult to go against the US dollar at the moment. You can see both these week highs have been taken. That opens up the idea that even 107 is possible now in the US dollar. And I wouldn't fade it just yet. There's no turnaround signs at this point. So still in a bull trend. It's a bit boring to say, but yeah, at this stage we cannot go against it. What about with gold? Well, gold's taken a new low in terms of the close. It does look kind of weak here on the charts. And I think that's important to note that gold's very tricky at this stage. There are buyers coming in on the stocks. There's no doubt. We're seeing big volumes. But again, when you look at the spot, it's holding up better. But the higher yields go, generally speaking, unless we're in stagflation, gold does tend to suffer. US oil, pretty strong looking bounce off the 20 moving average here on the daily. You can see that red line. Look at that nice little bounce there. And it kind of looks like it's putting in like a double bottom style pattern. So if we go smaller time frame, we go back to the 2 hour, you can see that's a fairly significant break that's happening here. We get above 91.319, maybe this little area here. We should be looking at a new high for oil. So pretty good pattern, fairly strong buying, wipe the low, which means it's probably got some shorts that's trying to squeeze out. So this is a fair trade, I think, for some people. Oil looks a little bit stronger than you'd think. And again, if oil's going up, maybe markets have further sells to go. Amazon and every other big tech stock all dumping into their demand zone. So you can see here, Amazon's right back down. I like this because, again, while I'm not going to predict this is an excellent level, don't get me wrong. I think there are buyers around here. I really enjoy this structure over on the left-hand side. So I think, we get back above structure. That's probably the end of the selling, in my opinion. At this point, we are still in a sell. We're definitely at a buy level that a lot of people will like, but I'm not sure if it's going to hold just yet. Google is similar. You can see back down to the lows. Microsoft is similar, though they made a new lower low. So you can see here, new lower low, but again, back into the structure. And pretty much all of these stocks are doing similar things. I would say that Meta's been holding up amazingly well in comparison.